Nokia is no longer being valued like a slow telecom equipment company. The market is suddenly treating it like an AI infrastructure winner. That is a massive shift. The problem is that most of Nokia's actual business is still stuck in a brutally competitive telecom market with weak pricing power, flat growth, and customers constantly trying to cut spending. The entire bull case now depends on one thing: whether Nokia can successfully transform itself into a data center and optical networking company before its core business becomes commoditized. The core mobile networking business is basically stagnant, and that matters because it still represents around 65% of total revenue. Telecom operators are spending cautiously, margins remain under pressure, and technologies like ORAN are making hardware more interchangeable and less profitable. Meanwhile, the real growth is happening in optical networking and AI-related infrastructure after the Infinera acquisition. Optical networking sales recently grew 20% organically. AI and cloud customers are becoming a much bigger part of revenue, and Nokia is finally seeing some margin improvement from that mix shift. But investors should understand the bigger picture here. Nokia is not suddenly becoming a high-growth AI company. Morningstar still expects only around 4 to 5% long-term revenue growth despite all the AI excitement. This stock looks expensive if you judge it as a telecom equipment company, and probably still expensive even if you believe in the AI pivot. Morningstar's fair value estimate is €7.30, while the stock trades around €11.92, implying the market is pricing in a much more optimistic future than analysts expect. The current valuation only makes sense if Nokia becomes a serious long-term AI infrastructure winner with sustained optical networking growth, margin expansion, and meaningful market share gains against stronger competitors. Otherwise, investors are paying premium multiples for a company that still has no economic moat and historically weak returns on capital. Nokia's strategy is actually logical. Management understands that telecom networking alone is not enough anymore, so they are aggressively repositioning the company toward AI data center infrastructure, optical networking, and software. The Infinera acquisition was the clearest signal of that shift. Instead of depending entirely on telecom carriers, Nokia wants exposure to hyperscalers, cloud providers, and AI infrastructure spending. That is the right direction because those customers spend more aggressively and offer better margins. The risk is that Nokia is trying to reinvent itself in markets where the competition is extremely strong and technological cycles move very fast. This is one of the biggest problems for the thesis. Nokia is fighting Ericsson in mobile infrastructure, Ciena in optical networking, Cisco in enterprise networking, and even Samsung in parts of wireless infrastructure. In telecom hardware, differentiation is weak and customers care mostly about cost. Nokia already lost important contracts to Samsung and Ericsson in previous years, which proves switching costs are not as strong as many investors assume. In optical networking, Nokia is growing, but Ciena is still viewed as the technology leader and often launches new capacity standards faster. Cisco is also slowly pushing deeper into optical infrastructure. Nokia has opportunities, but it is competing against serious companies with stronger positions in multiple markets. The biggest risk is simple. AI spending slows down before Nokia fully transitions away from telecom dependence. If hyperscalers reduce data center expansion or AI monetization disappoints, Nokia loses the most important growth engine supporting the current narrative. At the same time, the legacy telecom business faces commoditization pressure from ORAN technology, customer pricing pressure, and constant R&D demands just to stay competitive. Nokia spends billions every year on research and development, but still has no moat according to Morningstar. That is dangerous because it means the company may need huge investment simply to maintain relevance rather than generate exceptional returns. The upside case is powerful if management executes properly. If AI infrastructure demand remains explosive for the rest of the decade, Nokia's optical networking segment could become nearly as important as its mobile infrastructure business by 2029. Margins could expand significantly as software and high-performance networking become a larger part of revenue. Nokia also benefits from geopolitical restrictions against Huawei and Chinese telecom vendors in Western markets, which limits competition. In the best-case scenario, Nokia transforms from a low-growth telecom supplier into a critical AI infrastructure provider with improving profitability and a much stronger customer mix. This is no longer a boring telecom turnaround stock. Nokia is becoming a high-risk AI infrastructure transition story. The opportunity is real, but so is the hype. Investors are betting that Nokia can escape a commoditized telecom industry and become relevant inside the AI data center build-out. That can absolutely work, but it requires near-perfect execution in markets filled with brutal competition and rapid technological change. This stock is for investors who believe AI infrastructure spending will stay massive for years, and that Nokia can capture enough of that wave to fundamentally change its business model. If that happens, the upside is meaningful. If not, this could end up being another expensive telecom stock pretending to be an AI winner. I'll break down the next one soon. Subscribe if you want to stay ahead.